the initial recognition, the first level recognition of an asset, of a liability, and the subsequent to it. The reason is that these are all the factors that we are going to talk about in terms of development. How early we are able to recognize the values, how early we are able to recognize the financial importance that has been told about. Matters a lot in terms of understanding the levels of disclosure. Good morning and welcome to the 7th session in Unit 5 in International Financial Reporting Standards, where we are going to talk about financial instruments disclosure. Now, this is a very important act as per the Accounting Standards 107, where we're going to speak about the initial recognition. Now, the Indian Accounting Standard 107, Financial Instruments Recognition and Measurement, and it also deals with, among other things, initial recognition of financial assets, liabilities, measurement and subsequent to initial recognition, impairment, and the hedging accounting. Quite a lot of things that we are going to talk about in terms of the Indian accounting standards, but nevertheless, why? Because these are all the factors that we have been trying to understand and assess ourselves. Now, for example, when we talk about the Indian accounting standards, especially 107, for most of the company today, the initial recognition, the first level recognition of an asset, of a liability, and the subsequent to it in terms of measuring the values, measuring the outcomes altogether, start coming into picture, because that is where at a given point of time, you will be able to understand what exactly the company owns, what are all the liabilities, how much we have hedged, how much we have kept in for the development of the company. Now, moving further, let's try to understand the generally accepted accounting principles. That is, the GAP says the financial instrument as cash, evidence of ownership interest in other company, the entity, contract, and all those factors which are following in nature. The reason is that these are all the factors that we are going to talk about in terms of development, and these are all the factors that we are going to earn altogether in terms of the growth aspects. Now, there are certain factors where we are going to talk about, which is going to tell about imposing on one entity a contractual obligation to deliver the cash or other financial instrument to the second entity, followed by to exchange other financial instruments on potentially unfavorable terms with second entity. It also conveys that the second entity has a contractual right either to receive cash or another financial instrument from the first entity, to exchange other financial instruments on potentially favorable terms with the first entity. So you are able to see that across the entire standard, we are talking about financial arrangements which are being either exchanged or which are being valued or which are being thought about or focused about in different levels and different obligations altogether. So, when we look into this generally accepted accounting principles, any of the financial instrument which is used as a cash or evidence of ownership interest in a company is being spoken about, or a contract that follows, all these natures are coming into picture because they are trying to deliver, they are trying to tell you that there are certain obligations, there are certain factors which has to be understood, which has to be done from a financial aspect, with financial transaction perspective altogether. Now, first of all, when we talk about the delivering of cash and other financial instruments to a second entity. So suppose one organization is transferring the financial assets to another organization, to another entity altogether, that has to be recorded. Followed by to exchange other financial instrument, because there might be a lot of cash transactions that happens from one organization to the other organization. And second thing, it conveys the second entity a contractual right either. So that is very, very important. Followed by to receive another financial instrument from the first entity. This is very, very important. Why? Because we need to receive that factors. We need to understand how it has been recognized. Followed by the exchange factors. How much instrument, what are all the factors that we are exchanging in return in terms of the factors of the financial transaction altogether. Followed by the objectives. The objectives of this great Indian accounting standard is to require entities to provide a disclosure in their financial statements that enable users to evaluate. So we are following the standard more from the evaluation perspective, so that every user is able to use this and able to arrive at a decision altogether. The principle of the Indian accounting standard is a complement that the principles for recognizing, measuring, presenting financial assets and instruments, which is a very, very important factors that are listed in the Indian accounting standard 32, financial instruments presentation, and that of the financial factors that we have been speaking about. So somewhere down the lane, the accounting standards, the accounting methodology itself has been really superb in terms of telling the factors, how early we are able to recognize the values, how early we are able to recognize the financial importance that has been told about. The next thing is that when this Indian accounting standard requires disclosure by a class of financial instrument, an entity shall group financial instruments into the classes that are appropriate in nature of the information disclosed to take that into account and the characteristics of the financial instrument. So we are more concerned about the factor that we want to recognize, we want to acknowledge the factor of the financial instruments, of the financial factors, how it is engaged and what are the values. So we are going to acknowledge the same first, and then entity shall also provide sufficient information that permit reconciliation to the lines of item presented in the balance sheet. So that's also very, very important for all of us. Why? Because an entity shall provide sufficient information. So it has to tell very, very clearly what has been the various factors, where have been we in terms of understanding the growth aspects, the reconciliation stands and all those factors, because these are all matters a lot in terms of understanding the levels of disclosure. The significance of financial instruments for a financial position and performance is something where the entity shall disclose information that enables its financial statements to evaluate the significance of financial instruments and its position and performance. So what is going to happen is that the entity will first enable the users to understand what is the financial position, why we have to follow it, what is the significance that is involved in terms of doing it, and how do we need to look into it from a serious perspective, from a serious growth aspect, because evaluation of this financial instruments and the factors are getting into a better position, are getting into a better usage when we are using this instrument, when we are using the standard, so the users are able to make better decisions. Followed by the categories of financial assets and financial liabilities. What are the category assets? We look here, the financial assets measured at fair value, those which are designated such upon the initial recognition and subsequently when it moves ahead. So when you look into the paragraph of 6.7 as given on the Indian Accounting Standard 109, and those which are mandatorily measured at the fair value through the profit and loss accordance of the 109. So everywhere down the lane, you will be able to see that there has been a whole lot of exercise that has been done, a whole lot of entity workout that has been done, which tries to tell you what are the factors under which we are working, what are the factors under which things are going to be measured in terms of using this particular standard. Followed by the financial assets or the financial liabilities at fair value through profit and loss. So if the entity has designated measured at the fair value through the profit and loss financial assets, that would be otherwise be measured at fair value through the other comprehensive income amortized cost that it shall disclose, followed by the maximum exposure to the credit risk factor of the financial asset or the group of financial assets at the end of the reporting period. So all these factors will be notified through it. So if it has a designated measure, if there's already a particular standard, a particular way of measuring it at the fair value, that would be measured, or it will be done through a comprehensive income or an amortized clause that it shall disclose altogether. So somewhere down the lane, the standard is going to be set and the standard is going to be followed in accordance with the IFRS. Now, the other thing that we are talking about is the amount by which the related credit derivative instruments, if they are going to be any, even those instruments are going to be recognized. They are going to be clearly told here, followed by the amount of change during that period in a cumulative manner, so that the financial asset that is attributable in the line of credit risk is also being determined. So on a cumulative basis also, the financial reporting is going to be done, which will tell you at what levels and what standards they have been following it. With that, I come to the end of this particular session. I hope and believe that this session was of a great help and resource to you. In the upcoming sessions, we shall be speaking more about the financial standards and aspects that are going to be recognized in the modern corporate world. Until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me today on this wonderful session.